Good morning, everyone. This is Joe from New York Trading Room. Today is November 4th, 2021.
Second hour of Squawk Box in your headlines. The Fed says it's time to taper, announcing plans to ease back on its huge stimulus program through the pandemic era and slow its monthly bond purchases from this month while dismissing any calls for an interest rate hike.
What it really boils down to is something that's common sense, and that is risk management. We have to be aware of the risks that we're particularly now the risk of significantly higher inflation. We see shortages and bottlenecks persisting into next year.
And we're waiting on the Bank of England announcement today, which is potentially set to hike rates in the face of surging inflation. But with analysts suggesting the vote is likely to be split, with some policymakers preferring to wait until the December meeting. Tune in for our decision time coverage at 1300 CET, and then a special interview with Governor Andrew Bailey at 1700 CET.
Credit Suisse warns of a loss in the fourth quarter as Q3 net profit slides 21%. The Swiss banking giant also announces a major strategic revamp, reorganizing the business into 4 separate divisions under a new leadership structure. SocGen announces the surprise departure of its CFO as it reports an 80% jump in third quarter net profit and launches a share buyback of almost €500 million.
Deutsche Post Dhl moves higher in pre-market as it raises its short and mid-term profit target. CEO Frank Appel tells this show he is confident about a continued rebound.
The world is recovering from the pandemic, and that will proceed in the next years as well. And that's the reason why we raised our outlook for 2023 as well.
Welcome back, everybody. The Federal Reserve will begin tapering its $120 billion per month bond buying program from this month, marking the first pullback of its pandemic relief package. From this month, the Fed will cut its asset purchases by $15 billion per month amid progress towards its goals for the U.S. economy. Meanwhile, it's keeping to its line on high inflation, but with a subtle difference, now saying it's, quote, expected to be transitory, and still shrugging off calls for an imminent rate hike. The market is now pricing in a rate rise around the summer of next year.
The Fed has largely held on to its view that high inflation remains transitory, but with a subtle tweak in its wording. In its statement, the central bank said pricing pressures are now, quote, expected to be transitory rather than driven by transitory factors. The U.S. CPI for September came in at 5.4% year-on-year, the highest reading since 2008. But Fed Chair Jerome Powell insisted inflation is on track to meet the Fed's test despite the current pressures.
We expect them, and the public will expect us to expect them to understand and be in a position to manage their risks. So that's physical risk and it's transition risk for climate. And by the way, the large financial institutions are doing this already, and you know, we think that's right within our mandate. We're aware that that language sounds a little out of touch with what's going on, but you know, we're not at maximum employment. When that is the case, we'll look to see whether the inflation test is met, and there's a good chance that it will be if you look at how inflation has evolved in the last year and a half.
Well, plenty of analysts have been weighing in on how to interpret Fed Chair Jerome Powell's comments yesterday. One line that stuck out to me was from Steve Englander. He said that investors saw more velvet gloves than iron fists from Powell. But the question is whether this benign environment will remain in Q4. So Still a decent amount of uncertainty, but for now, investors seem to be taking some reassurance from the consistency offered from Powell and the broader Federal Reserve. So U.S. markets, we saw U.S. equities hit fresh all-time highs yesterday. The Dow Jones rose about 105 points to just over the 36,100 level. S&P 500 ended the day 0.6% higher, and the tech-heavy NASDAQ outperformed. That index rose about 1%. U.S. banks, let's take a look at how the banking sector fared. For the most part, we saw U.S. banks move higher, but not all of the U.S. banks, and overall fairly contained moves. So it seems as though investors were braced for what we got from the Fed yesterday. No huge surprises. Goldman Sachs ended about 1.4% lower. Morgan Stanley about 2%. Those were the underperformers. On the upside, Wells Fargo, Bank of America, JP Morgan, and Citi all saw their shares rise yesterday. U.S. Treasury yields. Let's take a look at the bond markets. The U.S. 10-year currently trading around 1.6%. The 2-year yield around 0.5% at the moment. And out at the end of the curve, the 30-year note is trading with about a 2% yield this morning. Dollar crosses. Let's take a look at the U.S. dollar. Yesterday, we saw the U.S. dollar retreat. This morning, we've got sterling and the dollar and the euro both trading lower versus the dollar. So a little bit of strength coming into the greenback this morning. Sterling trading around 136.59. I think it's fair to say that for sterling today, investors are firmly focused on what Andrew Bailey has to say at the Bank of England. Euro trading around 115.80 versus the dollar. Jeff.
Let's bring in Richard Kelly then. Richard is head of global strategy at TD Securities. Richard, good morning to you. Has the Fed pulled off the perfect landing?
I guess, I mean, they communicated this very well, and that doesn't always, mean the markets digest it. So far, yes, I would say everyone was well prepared for the fact that we're going to announce tapering. There were no surprises. And in terms of the press conference, I think it was much more about what would he signal about rate hikes and the pace it was priced in. And so far, the markets bought the message he was dishing, which was basically, we're not here to discuss that today. So I think that tension will still be there for the markets, but we at least got out of the meeting with the markets feeling okay enough with the message they had.
It was interesting, wasn't it, how the bond market reacted? I know there was some commentary from our colleagues in the States that maybe Powell had tempered any tantrum tendencies with the joint announcement about supply. And if anything, that may have suppressed the market's reaction. Can you comment on that and what that likely means for the shape of the curve?
Right. I mean, I don't think it's coordinated per se, but it's certainly probably helped in that by having a bit less coming in than maybe people were looking at across that side of things. I think overall what we've done here is we are still tapering.
You can see we took first trade with 464.
Coming in next year. I still think that's going to be a 2023 story. So it means you've got upward pressure on the long end. It means we're probably overpriced on the front end. And so I think we're still biased towards steepening over that pace. But what you'll see is we are still very much data dependent. So anytime you get strong data, if anything starts to confirm that, maybe inflation is not going to be as transitory, maybe the Fed's hand is going to be forced, that's going to get you back into that flattening move. But I think just looking at where we're at, it should be a bias towards steepeners from here for now.
Richard, Powell tried very hard to make clear that the Fed looks at interest rate policy and bond purchases as two very different entities and really tried to separate the two, emphasizing that the economic bar is much higher for rate hikes. Do you think that the market believes that guidance?
I think if you look at the evidence we've had, we've now gone through the ECB. I think it really is a coin toss at this point. If you look at the market, it's pretty much 50-50 after the comments we had from Governor Bailey. I think it's more likely than not that we get a rate hike delivered today. I'm expecting.
We are monitoring, I think he said 9,300 public listed companies. We know exactly how much CO2 they're emitting on a regular basis. And he said we're going to expand that to the 15,000 private companies as well, that are also financed by the banking sector as well. That information's there now, Bill.
And that's the basis for our, it's not 100% to be clear, but that's the basis for our plan. Like we've covered in the white paper that we put out last week, we covered 70% of the emissions of Standard Chartered Bank with the commitment to get to the remaining 30% over the next 12 months. But we're not screwing around. We're reducing our climate emissions every single year. Not just from our own operations, that we can deal with very straightforwardly because it's relatively small, but from our clients. But that's going to require trillions of dollars of financing. Obviously not all coming from Standard Chartered, but that's what we're talking about. Right? $3.5 trillion per year.
Follow up on that finance. Jeff's desperate to get in as well. Just beg my indulgence, Jeff, a second, because this GFANS announcement, I mean, again, I blame Mark Carney for everything in terms of these ridiculous amount of acronyms he's giving you and I now, and you're involved in a load of those acronyms, by the way. So the Glasgow Financial Alliance for Net Zero as well. This massive figure, $130 trillion mentioned yesterday as well. But that money's not in place now, and that money's not all invested in sustainability, is it? It's going to take a long time.
No, of course not. No. The 130 trillion is the transition. Is that too fast or too slow? It's a pretty tough nut for the poorer countries in the world that are dependent on coal-fired power. And the approach that we've taken throughout this is to have contribute to the just transition, right? The just transition that we've been hearing about, to allow these countries to continue to pull themselves out of poverty to the greatest possible extent, while helping them to transition to a very low carbon business model. So we've calibrated this, we've changed, we've accelerated the pace just over the last couple of years. Perhaps we'll find ways that we can accelerate even further. But we are allowing for an element of ongoing economic growth and activity in some of these markets, because otherwise it's simply unjust to deprive many of the poorer countries of the world the opportunity to deliver power to populations who are